Bring in Brian Levitt now of Invesco and Shannon Saccocia of NB Private Wealth. It's good to see both of you. Brian, you've been sitting here listening to Adam. You want to agree, disagree? What do you think about where we are here as we start September?
Well, I think where we both agree is we've seen signs, leading indicators of the economy showing that things are going to be slowing here a bit. And so it makes sense to be a little bit more defensive tactically in a slowdown. But I actually would suggest that we're starting to move towards better policy clarity than we've had in quite a while. That, if you think not that long ago, we were dealing with 9.5% inflation, the Fed raising rates multiple times. We're now on the cusp of the easing cycle. Now, personally, if I was running the central bank, I would have eased earlier than this. So the risk now is really on the growth side. It's not on the inflation side. The risk is, does this economy remain resilient through this? Right now, basically everything you're seeing with regards to leading indicators, recession warning signs are not flashing. Leading indicators of the economy are slowing a bit, not collapsing. So it suggests a fairly resilient economy, but a slowdown where investors get a bit more tactical.
So what would you would have done an insurance cut in July?
I would
just to head off some of the things that you
to your earlier point, we're sitting at a 5.25% Fed funds rate when their preferred measure of inflation is 2.5%, when the 10-year Treasury is below 4%. Right? It doesn't make a lot of sense to be this tight. Now, of course, they're still focusing on an environment a year or two ago where inflation was significantly hot, but that was really the byproduct of a bizarre environment in which we shut down the global economy and didn't have enough stuff on the shelves for the first time in a while. So inflation back in the comfort zone, and the economy slowing, unemployment rates picking up a bit, I would have been easing.
So, Shan, I want to, jump off with you with a debate over where to be in this market, okay? Because Adam lays out pretty clearly his view about where he thinks you maybe should be and where he thinks you shouldn't. He said, I don't understand the small caps idea. You've been arguing for broadening areas of the market. Maybe small caps are part of that too. So are you having second thoughts about that? Help us.
No, we're not. I think, Scott, you and I have had this conversation very frequently in terms of our view that we did think that earning expectations for mega cap tech and communication services, that they were a bit lofty. And, whether you want to look at valuation, which is certainly lofty, but I think Adam makes a good point in terms of the vulnerability of the earnings estimates for those companies. Just they look more vulnerable than other parts of the market. We can talk about some of the sectors, this barbell that I think a lot of people have put on in their portfolio, whether that's, you've got some semis on one side and you've got some healthcare, utilities, REITs on the other side. And in the middle are a couple of those sectors that really no one's paying much attention to, right? Particularly areas like energy, materials, and industrials is one that's a hot topic. And I know Adam and I have had conversations about this over the years in terms of what the opportunity is in industrials. We like industrials, but really you're seeing a lot of barbelling, and that's because investors are reticent, they're hesitant not to have those positions in mega cap tech because every time we get a sell-off, there's a lot of volume that comes back into those names. We see that hockey stick, that sharp rebound, and people don't want to miss that. But on the flip side, they kind of know that some of these estimates, they feel a little bit toppy right now. And so I think it comes back to really, Scott, what do you think is happening in the environment? Do you think this kind of noisy normalization, a term that 22V Research had in a piece this week, do you think that noisy normalization is enough to make you feel comfortable being broadly allocated, that this broadening out, this cyclical rebound is going to continue, albeit perhaps at a lower growth rate? Or do you need to really batten down the hatches in this environment and go completely over to the side of defensives? I would argue that some of those sectors that have been historically defensive, however, have run up based on other megatrends like AI over the course of the last year. So it's difficult to kind of to execute a true defensive trade in this market. And I think that's why you're starting to see some of this whipsawing as we get back into higher volume, people back from the holidays.